Okay, so you want to own a toll road. You buy a stretch of asphalt, stick up a few toll booths, and every single car that passes by hands you money. No product to make, no employees to manage, no inventory. Just cars and cash every day, forever. Sounds like the closest thing to a money printer that actually exists in the real world. But here's the strange part. Some of the biggest toll road deals in history have ended in bankruptcy. Investors have lost billions on roads that were busy, well-built, and collecting tolls every single day. And at the same time, other toll roads have quietly become some of the most profitable assets on the planet, returning 12 to 15% annually for decades. Same business model, wildly different outcomes. So what separates the ones that print money from the ones that quietly destroy it? By the end of this video, you'll know exactly what it actually costs to get into a toll road, how the revenue machine works, what the hidden traps are, and what your profit actually looks like in two very different scenarios. So what does it actually cost to get into this business? Let's start with what you're actually buying. There are two ways to own a toll road. The first is building one from scratch. That's called a greenfield project, and the numbers are staggering. In the United States, the average cost to build a new highway runs somewhere between $10 and $40 million per lane per mile. Not per road, per lane, per mile. A basic two-lane toll road covering 20 miles in a flat suburban corridor might cost $400 million before you collect your first dollar. Add tunnels, bridges, urban land acquisition, or mountainous terrain, and that number can triple. The tunnel section of Boston's Big Dig cost about $14.6 billion for fewer than 8 miles. The second way to get in is buying an existing road through a long-term concession. A government leases you the right to operate and collect tolls for a fixed period, usually 30 to 99 years. You pay a massive upfront fee. The government gets cash today. You get the revenue stream for decades. This is how most private toll roads actually work. Indiana leased its 157-mile east-west toll road to a consortium called ITR Concession Company in 2006 for 75 years in exchange for $3.8 billion upfront. Chicago Skyway, an 8-mile elevated stretch connecting the Dan Ryan Expressway to Indiana, sold for $1.83 billion in a 99-year lease to the same group. These numbers sound insane until you do the math on what those roads were generating annually. Chicago Skyway was pulling about $85 million per year in toll revenue at the time of the sale. The buyers were paying roughly 21 times annual revenue. That multiple is actually normal for stable, long-life infrastructure assets. You're not buying a business, you're buying a utility with a government-backed monopoly attached. Beyond the purchase price or construction cost, you also need to budget for capital improvements. Roads need resurfacing every 10 to 15 years. Electronic tolling systems need upgrades. Interchanges sometimes need expansion to handle traffic growth. Figure an additional 2 to 5% of asset value per year in maintenance and capital spending, depending on age and traffic load. And then there's financing. Almost nobody buys a toll road with cash. These deals are highly leveraged, meaning debt-heavy. Typical toll road acquisitions use 60 to 80% debt financing, with the rest in equity. The debt is secured against the road's future cash flows. That leverage is what makes the returns extraordinary when things go right. It's also what makes bankruptcy almost certain when traffic falls short. Okay, so how do you actually make money with one of these things? The revenue model is almost childishly simple. Cars drive on the road and pay a toll. But the economics underneath are more interesting than they look. The whole business in one line. Traffic volume times toll rate times margin, compounded over decades of inflation-linked price increases. Let's break that down. Traffic volume is the number of vehicles using your road per day. This is the single most important number in the entire business. A healthy regional toll road might see 30,000 to 80,000 vehicles per day. A major artery in a dense metro area can exceed 200,000. Toll rates vary enormously. A short 5-mile commuter bridge might charge $2 to $4. A longer highway with 50 miles of road might charge $8 to $15 per trip. Trucks pay more, sometimes a lot more. A single heavy commercial truck can pay 5 to 10 times what a passenger car pays, because they cause significantly more wear on the road surface. On many highways, commercial trucks represent only 15 to 20% of traffic but generate 30 to 40% of toll revenue. Now here's one of the genuinely brilliant things about this business. Most toll concession agreements include automatic annual toll increases tied to inflation, usually CPI plus 0 to 2%. You don't have to negotiate with anyone, you don't have to raise prices awkwardly. The contract does it for you. Every year, automatically. A toll that starts at 3.00 in year 1 is 4.88 by year 20, at just 2.5% annual increases, and your fixed costs don't grow at the same rate. That gap is pure margin expansion. The second revenue stream is electronic toll collection, or ETC. You've seen these as EZ-Pass, SunPass, or Fast Track depending on where you live. Transponder programs don't just speed up traffic flow, they dramatically cut your operating costs. A toll booth with a human attendant costs roughly $250,000 to $350,000 per year per lane to staff around the clock. An electronic gantry system processes the same volume for a fraction of that. Fully cashless roads have operating costs that are 40 to 60% lower than mixed cash and electronic systems. The transition to all electronic tolling is one of the biggest structural improvements in toll road economics over the past 20 years. Third revenue stream, ancillary income. Rest stops, gas stations, fast food franchises, and service plazas on your right-of-way all pay you rent. The New Jersey Turnpike service areas alone generated about $140 million in revenue in a recent year. That's money that comes in whether traffic is up or down. Some operators also charge fees for fiber optic cable, water pipelines, and utility easements running alongside the road. It's small relative to tolls but adds up. Fourth stream, managed lanes. These are the high-occupancy toll lanes, or HATE lanes, built alongside existing traffic where solo drivers can pay a variable toll to buy their way into a less congested lane. The Virginia Express lanes on I-495 and I-95 near Washington, D.C. are a good example. Transurban operates them and charges dynamic tolls that shift with real-time congestion. During peak hours, a 10-mile stretch can cost $40 or more. Total annual revenue across Transurban's U.S. operations hit about $600 million in 2023. Put all of this together and you can start to see what the actual economics look like. A mature, fully electronic highway with 60,000 vehicles per day at an average toll of $5 generates about $110 million per year in raw toll revenue. Operating costs, maintenance, and administration typically run 25 to 40% of revenue on a well-run modern road, so you're looking at $66 to $82 million in EBITDA. That's earnings before interest, taxes, depreciation, and amortization, basically operating cash flow. That's before you pay debt service, which on a leveraged acquisition can eat up another $30 to $50 million. But the equity returns on that leveraged structure can be extraordinary. And what's the stuff nobody warns you about? Traffic projections. This is the original sin of toll road investing, and it has destroyed more money than almost any other era in infrastructure. Every toll road deal is built on a traffic forecast. Banks won't lend you $2 billion without a consultant projecting how many cars will use the road over the next 30 years. The problem is those projections are almost always optimistic. A study by Bent Flyvbjerg at Oxford looked at 258 transport infrastructure projects and found that toll road traffic projections were wrong, on average by 50% on the optimistic side. Not 5%, not 10%, 50%. If your deal is underwritten on 60,000 vehicles per day and only 40,000 show up, your entire financial model collapses. Debt service doesn't go away just because your traffic is lower than expected. The road still needs to be resurfaced. The gantries still need to be maintained. You're just doing all of it with 30% less revenue. The second trap is competing infrastructure. Roads don't exist in a vacuum. If a government decides to build a free bypass or upgrade a parallel road after you've already bought your concession, there's often very little you can do about it. This is exactly what happened to the Cross City Tunnel in Sydney, which opened in 2005 to connect the eastern and western suburbs under the CBD. The consortium paid $680 million for the concession. Traffic projections called for 90,000 vehicles per day. Actual traffic in the first year was around 30,000. Why? The New South Wales government made changes to surface roads that encouraged free alternatives. The tunnel went bankrupt in 2006, less than a year after opening. The investors lost hundreds of millions. The lenders took losses. And the tunnel eventually got sold at a massive discount to a new owner who underwritten on realistic traffic numbers and now operates it profitably. Third hidden cost, ramp-up time. New toll roads almost never hit their projected traffic in year one. It takes time for drivers to change habits, for GPS routing to adapt, for employers and residents to shift patterns. Industry rule of thumb. A new greenfield toll road takes 5 to 7 years to reach its stable traffic level. During that ramp-up period, you're paying full debt service on forecasted revenue you don't yet have. That gap is where many deals run out of cash. The road is working, people are using it. Just not enough people, not yet. Fourth, political risk. Toll roads are politically visible. Politicians love to freeze toll rates, mandate toll holidays, or threaten to nationalize concessions when prices get attention in the press. In Brazil, where private toll roads are common, several state governments have renegotiated concession terms mid-contract under political pressure. That's your projected cash flow, repriced. Most well-structured concessions have legal protections against this, but litigation is expensive, slow, and the outcome is never certain. Fifth, insurance and catastrophic events. A bridge collapse, a massive natural disaster, a prolonged road closure. Your revenue goes to zero while your debt service keeps running. You need substantial reserve funds and robust insurance, both of which cost real money. So who's actually doing this well? The most successful toll road operators in the world today are mostly large infrastructure funds, pension funds, and a handful of specialist companies. Transurban is probably the purest toll road company on the planet. It's an Australian company that operates more than 20 urban toll roads across Melbourne, Sydney, Brisbane, and Washington, D.C. as of 2023. Transurban manages about 1,100 lane kilometers of toll roads with annual revenue around 3.7 billion Australian dollars. Their average annual toll revenue growth has been 4 to 6% for the past decade, mostly driven by automatic price escalators. That consistency, year after year, inflation-linked, is exactly why pension funds love this asset class. Ontario Teachers' Pension Plan and the Abu Dhabi Investment Authority are both shareholders. In Europe, the king of the toll road is Atlantia, an Italian conglomerate that controls Autostrade per l'Italia, the operator of about 3,000 kilometers of Italian motorways. Those roads generated over 4 billion euros in annual revenue before Atlantia sold a controlling stake in 2022 following the catastrophic Morandi Bridge collapse in Genoa in 2018. The collapse killed 43 people and triggered a massive political and legal crisis. Atlantia eventually agreed to pay about 3.4 billion euros in compensation and divested its motorway unit to a consortium including CDP Equity and Blackstone. That deal is worth knowing about. Blackstone paid roughly 9.1 billion euros for a stake in the company. By some estimates, the underlying motorway assets were worth significantly more once the political damage was resolved. That's the other side of catastrophic risk. When things go badly wrong and everyone else runs away, sometimes that's when the asset becomes cheap enough to buy. In the United States, one of the most instructive examples is the 407 Express toll route north of Toronto. Technically in Canada, but often discussed alongside US infrastructure deals. Ontario built it in the 1990s, then sold it to a private consortium in 1999 for 3.1 billion Canadian dollars. At the time, many analysts thought the government got a good deal. The consortium, which includes SNC-Lavalin, Ferrovial, and the Canada Pension Plan Investment Board, has since generated tens of billions in toll revenue on that sale price. Ontario has described the deal as one of the worst it ever made. The 407 ETR raises tolls aggressively. There's no rate cap in the concession. In 2023, peak rates exceeded 72 cents per kilometer, making it one of the most expensive toll roads in the world. And traffic? Still strong. Because it's the only uncongested highway route north of Toronto. People pay because the alternative, sitting on the 401 in gridlock, costs them more in time. That's the anatomy of a perfectly positioned toll asset, a captive market, a monopoly route, and a contract with no rate ceiling. The Macquarie infrastructure story is the cautionary flip side. Macquarie became famous in the 2000s for rolling up toll roads and infrastructure assets across Australia, Europe, and North America under its infrastructure funds model. They were brilliant at the deal, and the model worked in rising traffic conditions. But several of their North American toll road bets, including the Indiana Toll Road before its restructuring, ran into traffic shortfalls, high leverage, and the 2008 financial crisis. ITR Concession Company, the group that paid $3.8 billion for the Indiana Toll Road, filed for bankruptcy in 2014. Traffic had recovered after 2008, but never hit the projections underpinning the deal. The road was bought out of bankruptcy by a new consortium including IFM investors for about $5.7 billion in 2015, essentially at a higher price, but now underwritten on realistic traffic with lower leverage. Today, the Indiana Toll Road is a stable, profitable asset. Same road, same trucks, different capital structure. So how do people actually lose their shirt on this? The failure pattern is almost always the same, and it's almost never about the road itself. You pay too much based on traffic projections that are too optimistic, financed with too much debt, in a market where you have less pricing power or less route monopoly than you thought. The road works, cars drive on it, the tolls come in. But the debt service is 1.2 times what the cash flow covers, instead of 0.8 times. And every year you're slightly more underwater. Then something happens. A recession cuts traffic 15% for 2 years. A competing road opens. A government mandates a toll freeze. And suddenly 1.2 times coverage becomes 0.9 times. And your lenders start making calls. You can't cut costs much. You can't raise tolls past what the contract allows. You can't generate more traffic by working harder. You're just waiting. The equity gets wiped out. Lenders take control. The road gets sold to new owners who paid less for it, have lower debt, and suddenly the exact same road with the exact same traffic is a great investment. The road was never the problem, the price and the structure were the problem. Okay, so what can you actually walk away with? Let's run 2 scenarios with real math. One that's achievable for a well-capitalized, smaller player, and one that looks like the big institutional deals. Scenario 1. You're part of a consortium that acquires the rights to operate a regional 30-mile toll highway in a growing metro area. Purchase price is $600 million. You put in $150 million in equity. The rest, $450 million, is senior debt at 4.5% interest over 30 years. Annual debt service is roughly $27 million. Year 1 traffic, 35,000 vehicles per day. Average toll rate 6.50. That's about $83 million in gross toll revenue. Operating costs, maintenance, insurance, and admin, $28 million, or about 34% of revenue. EBITDA, $55 million. After debt service, $28 million in free cash flow in year 1. That's an 18.7% cash yield on your $150 million equity stake. Now apply 3% annual traffic growth, metro population is expanding, and 2.5% automatic toll increases. By year 10, daily traffic is around 47,000, and average toll is 8.30. Annual revenue climbs to about $142 million. Operating costs, growing more slowly, are now $38 million. EBITDA is $104 million. Debt service, unchanged at $27 million. Free cash flow, $77 million. On your original $150 million equity, that's a 51% annual cash yield by year 10. And the asset has appreciated because the cash flows are now much larger. If you sell at year 20 at a 20 times EBITDA multiple, which is reasonable for a mature, stable road, you're selling an asset with roughly $180 million in EBITDA for around $3.6 billion after paying off the remaining debt. Maybe $250 million. You clear roughly $3.35 billion on a $150 million equity investment. That's a 22 times money multiple over 20 years, or about 17% annualized return. That is not unusual for a well-bought, well-run toll road concession. Scenario 2. The big institutional buy. You're a pension fund. You deploy $2 billion in equity as part of a $7 billion acquisition of a major metro toll network. This road system handles 150,000 vehicles per day across multiple linked corridors. Average toll is $9. Gross annual revenue, $493 million. Operating costs at 30%, $148 million. EBITDA, $345 million. Debt service on $5 billion of debt at 4%, $290 million. Free cash flow, $55 million in year 1. That's only a 2.75% initial cash yield. Sounds underwhelming. But this is a 75-year concession on a captive urban network with inflation-linked escalators. By year 15, with compound toll growth and traffic expansion, EBITDA reaches $600 million. Free cash flow jumps to $300+ million per year. The cash yield on original equity is now 15%. And you haven't had to do anything. The contract did it for you. That's actually how pension funds model these deals. Low initial yield, inflation-protected compounding, and a terminal asset value 30 to 50 years from now that they don't even need to discount very hard because the cash flow covers distributions along the way. The Canada Pension Plan, Ontario Teachers, Macquarie Asset Management, Brookfield Infrastructure, and Blackstone Infrastructure are all doing versions of this at scale, globally. As of 2023, Brookfield Infrastructure Partners owns toll roads across South America, India, and Australia as part of a portfolio generating over $4 billion in annual funds from operations. The business works when you buy right, structure the debt conservatively, and own a route that drivers genuinely have no good substitute for. Here's how you know whether a toll road is worth buying. Look at the detour. If the free alternative adds 15 minutes to a commute, drivers pay. If it adds 4 minutes, they don't. The value of a toll road is exactly equal to what drivers would lose if it disappeared. That's your pricing ceiling. Every profitable toll road sits at the point where the toll is cheaper than the driver's time. $1 toll to skip 20 minutes of gridlock is a no-brainer. A $40 toll to save 4 minutes is a no-brainer to skip. Everything between those is where the real pricing strategy lives. So in the end, here's what this business actually is. It's not a road. It's a 30 to 99-year government-backed monopoly on a stretch of geography that people cannot avoid, structured as a leveraged bet on population growth and inflation. When you buy it right, at a fair price, with conservative debt, on a route that has no real substitute, it's one of the most consistent wealth compounding machines ever invented. When you buy it wrong, at a peak price based on optimistic traffic projections with 75% leverage, the road keeps working perfectly and you go broke anyway. The asphalt doesn't care who owns it. It just keeps collecting money. The question is whether any of that money eventually makes it back to you.